So welcome to our afternoon session about the Dash Investment Foundation. I'm Sven Rossbach. I'm one of the supervisors. And normally I would be walking around on stage, but today, because we have a large online audience, we're going to do this sitting down. Let's begin by going down memory lane a little bit. Everybody knows what this is. It's our treasury system. And this is a proposal that was filed in, or actually paid out in 2016 for a company called Living Room of Satoshi for 1,000 Dash, who promised to build a company that allows people to pay their bills with crypto. Now, fast forward, Living Room of Satoshi is live and well. This is their homepage. And there in the drop-down menu, you can see the payment options they are offering today. And it's in alphabetical order. Something seems amiss, perhaps. Well, just to be sure, there's their statistics page. And here you can see how much bill volume has been paid with each cryptocurrency. And I give you a moment to try and find Dash in there, or maybe help you out because it's a little small. It's not in there. So that's the problem, of course, of our treasury system, that it was recognized pretty early on. The treasury is paying out grants. Commercial companies are taking the money, building profitable businesses based on it, keeping all the profits for themselves, and in many cases even are not remaining loyal to Dash. So the Dash network is financing these projects and not really getting anything in return. And this has happened a few times. Problem was recognized, and back in 2017, Ryan Taylor, who back at the time was CEO of Dash Core Group, tried to figure out a solution and started meeting with lawyers and asking them to come up with a study to figure out what kind of setup we could use to handle these sort of cases better. Again, then a few months later, in April 2018, their report was received, and they recommended a specific Cayman Island structure. Now, let's have a look at what that looks like. It starts with the Dash DAO on the bottom. The Dash DAO elects a board of supervisors. Those are 6 people, and the supervisors appoint a board of directors. Those directors, they physically sit in the Cayman Islands, and they collect the funding that comes in via funding proposals from the DAO. Then the supervisors hire a fund manager who gets paid from the directors. The directors keep the funds that coming in from the Dash DAO in custody. They are not owning it. They just, they're there. Somebody has to move things around, and they're the ones and sign off on behalf of the diff. The fund manager then takes on the day-to-day business of the diff. So that's on one hand, filing funding proposals, but of course also going out and creating deal flow, identifying potential investment targets, and doing due diligence. The fund manager will then communicate, make recommendations with the board of supervisors, and the board of supervisors make the final investment decision, communicate that to the board of directors, who then take the funds that are in their custody and make equity investments to those companies, and in return they get a hold of an equity share. So with that structure in place, we started looking for who these directors could be. A search for legal counsel commenced. The directors were signed in May 2018. And then finally, in end of May 2019, it took a couple months because there's a lot of legal filings and due diligence and verifications what the Cayman Islands require. So, but finally, in March 2019, it was ready. We had an ownerless Cayman Islands Foundation company. And the word ownerless here is in bold because it's a very important term. There are no shareholders in this company in the common sense. You cannot trace back the ownership of the Dash Investment Foundation to an ultimate beneficiary who is a human. There's no human at the end of the line. Here's the document that made it official. You see the date, March 2019 on the top left. And with that, the diff was finally in operation. Was announced in the blog, first blog post in May 2019. And then just a month later, we had the first funding proposal to enable the diff to actually go and make investments. Now, let's revisit that structure we just discussed. In the beginning, that was indeed how the diff was set up and operated. A fund manager was hired. There was a lady called Demelza Hayes, who did really good work in the beginning, introducing processes to the diff and defining a balancing structure, for example. However, we're 2019, 2020 now. The exuberance of 2017 had kind of subsided, and quickly we realized that at the league we're playing in, the amount we're playing with, a permanent fund manager is just beyond we're not in that league yet to have a permanently employee on the book. So decided to continue without a fund manager, and now you have some of these tasks kind of dangling in the air, and ultimately the board of supervisors ended up taking on these jobs, and we ended up with a somewhat simplified structure that is still being utilized today. So we as supervisors, we make the investment decisions, we also do due diligence, we create deal flow, we write funding proposals, and we do everything else that is required to keep the diff running. But with this structure in place, we were finally ready to hit our mission. And yes, we actually do have a mission statement that has been around for quite some time. Here I just grabbed a screenshot from one of our earlier quarterly reports, where one of our previous supervisors, Darren Tapp, is presenting it. So the Dash mission is the DIF will invest in ecosystem partners on behalf of the Dash DAO to grow Dash footprint and deliver greater value with the resources available. So basically what we are talking about is an angel investment, VC investment model. Now, just to be clear, that everybody understands what that means, a few words up front about what that means to get involved in angel investment. First of all, these are long-term investments. We're helping entrepreneurs grow a business. That means when you buy somebody's shares, you can't go back a year later to the entrepreneur and demand him to take the shares back from you and give you your money back. It's like you buy a used car from someone and you drive it around. You can't go back a year later and demand the previous owner to buy it back from you. It doesn't work that way. So you're in it long term. You have to support your entrepreneurs. You have to help them grow their business and make it successful, and then you will also be successful as an entrepreneur. From that also follows that there is not really a ready, liquid, on-demand marketplace for these kind of startup shares. There is not an exchange where I can go and trade, buy and sell these sort of shares on demand. So if I suddenly find myself in the urgent need for cash, I have a problem. So it means I have to manage my liquidity up front, because I won't be able to just offload a stake in some startup company when I happen to need some money. Along with that comes also the third point. That means the valuation is often quite unclear. You of course, you know what you paid for your share, and it gives you an idea of what the company as a whole would be worth. And the same happens when there are follow-up financing rounds. Like when another investor comes in sometime later and pays $2 million for 10% of the company, then you kind of know the entire company is probably worth 20 million, 100% of the company. But unless that happens, it's kind of, a guessing game, just looking at how the company is doing to try and derive how much that company may be worth today. Ultimately, it's worth as much as somebody is willing to pay for it. And that happens in follow-up rounds. Also, angel investment is inherently risky. It's the dark secret of the angel and VC investment world that typically maybe 1 in 10 investments will become the kind of outsized success that ends up carrying the whole portfolio. But you will also typically have quite a lot of failures, and so you need to be prepared for that. So now with that in mind, let's see how we've been doing. Take a look at our portfolio, our assets. Start with the liquid assets that we have today. We're kind of spread out over a few different wallets. Not too exciting yet, but one thing I do want to point out, that one block Eldorado wallet is relatively new. And the two biggest positions there, 20-something thousand each of Kakao and Dash. That is the liquidity pool that we started to support the Maya platform on behalf of the Dash network. So these amounts are kind of locked away. I mean, yes, we could sell those, but we don't really want to because we want to keep the liquidity pool going. But otherwise, this is the amount of liquid assets we have available as of today. Now, as for our equity portfolio, we keep our equity portfolio on our books at cost value. So why? I explained earlier, coming up with a new valuation is difficult. You kind of, when some of the portfolio companies go through follow-up financing rounds, we can tell what the valuation of that company was at that next financing event. But even then, we follow prudent bookkeeping practices and generally accepted accounting rules. And you don't really want to realize a profit by upgrading your asset holdings, because then you would potentially be liable to pay taxes on your gains, even though you haven't sold anything yet and you don't have the liquidity to do that. Now, that doesn't really apply to us. We're a Cayman Island company. We don't have to pay taxes, but we still adhere to the same rules. So for bookkeeping purposes, our assets are listed at cost value. And I'm going to talk to a few of those that I think might be the most interesting ones and take a closer look at some of these portfolio companies, not at all of them as we won't have time. But let's start with kind of more like the bad news. So ReadyRadar was actually the first investment that Div did. And in this case, the decision to invest in ReadyRadar was not made by the supervisors, but it was actually made by the DAO itself. There was a proposal out there that also included funding for this investment. It was voted in with a very large margin. In 2020, now I just went to their website a couple of days ago. It's a gaming company that organized gaming events where you could use Dash to pay for certain things in game. Well, the last event they listed on their website was in February 2021, so like 2.5 years ago, and since then it's been kind of very quiet. The company is still registered in the Pennsylvania Department of State, so it still exists. However, the owners have not been the most responsive, so we're still on the ball trying to figure out what the situation is there, but I would consider this one a write-off. Next up, PayPay Ionia. What do most people associate this one with? Dash Direct, that's right. And of course, that it was a great asset to the Dash community and to the Dash network. Unfortunately, it did end up getting shut down this year. However, Dash Direct was based on a patent that Ionia is holding, and that patent is enabling a range of other business applications. And Ionia actually has solutions currently in beta that look very promising, where they are enabling uh, uh, payment systems for. I'm not really at liberty to disclose who they're talking with yet, but they have signed partnerships with very significant companies, the names of which is known to us, but I'm not able to announce that yet because it hasn't been made public by the company yet. But let's just say one of the companies I have in mind now is a real industry heavyweight, like we're talking $100 million range in the property management space, roughly speaking. They expect to launch the payment processing product based on that patented technology with them in Q1 next year. And they expect this to be a very profitable product. And so if you look at our investment history with them, we invested in them in 3 tranches. The first one in December 2020, at a valuation of just under $5 a share. Then we invested the next tranche, again 100K at $12.38 a share, and the final one just last year, the valuation from $24.75 per share. So you see, a valuation has grown steadily. It looks very promising, and along with the product launch, Ionia is planning a Series A round next year. There are talks with investors already. There are also very well-known names in discussions with them. The target for that is $50 per share. That would put our value at 1.76 million, or roughly 5.8 times what we paid in. Ionia is also saying we do not anticipate additional fundraising after Series A, so potentially there could be a strategic buyout in the books or an IPO. We will discuss, and certainly also listening to community feedback, if and when we should offload Ionia. Then keep in mind our mission is still to grow the Dash ecosystem and support companies that in turn support Dash. Ionia doesn't pay that anymore, but it would also be foolish to just try and somehow create a fire sale. Also keep in mind, as I said earlier, you have to find a buyer for your shares. Typically buyers come in follow-up financing rounds. Whether that Series A is an opportunity for us to get out and under what valuation, we'll see. But I think it will be very profitable for the diff. Next up, Valkyrie. There's another frowny face that was also Valkyrie launched a Dash Trust. It was an instrument that allowed everyday investors that didn't want to deal with wallets and technology to invest in Dash and to even put their retirement. You could add this to an IRA here in the US. So unfortunately, the subscription to the Dash Trust weren't really in the range where it would make sense for Valkyrie to continue this product, and eventually got shut down. But again, let's look at our history with them. We started investing in Valkyrie with the condition of them launching that trust in December 2020. We put in 100K at a $9 million valuation. So that's what the company was estimated to be worth back then, the entire company. And then a couple of months later, we saw Valkyrie announcing a Series A fundraise. They raised $10 million at a time, and that immediately, at a valuation of $42 million, and that put we did participate in that raise, but it put the share that we had bought earlier at a value of $467,000. Then In May, the Dash Trust, May 2020, so roughly a year later, the Dash Trust got closed. It was a bit disappointing also for me personally, because I actually personally put a lot of work into trying to get it going and to save it. Ultimately, it didn't work out. But just after the Dash Trust closed, Valkyrie announced another fundraise, this time for a strategic fundraise for $11 million. Typically, when companies announce follow-up fundraisers, it comes along with an increase in valuation if the company does well. However, the Valkyrie business is also pretty closely tied to the crypto market overall. So it wasn't quite clear what that would do to the value of our shares, and I'll get back to that in a moment. But a few days after they announced that, we received a buyout offer. So unsolicited, the CEO sent me an email, or sent us, all supervisors, an email and said, "Hey, I want to buy back your shares for $150,000." Now, remember, we just a few months ago, we had evaluated our share at over 400K. And also, the CEO disclosed to us that she is in talks with a large strategic investor for a potential merger. So somebody would buy out the entire company, and it seems to us that clearly she knows more than we do at this time. If she comes forward with such an offer, she is not doing that to do us a favor. She's doing that because she thinks, it's favorable to her. And it seemed like such a lowball offer at a time that we declined. Also, with views of the fundraise that had just been announced and this merger that you was talking about, there would definitely be a higher valuation for us to be had. Now, I mentioned earlier already that the time was 2022. This is what a crypto market looked like in 2022. Just representing for the market overall, this is a Bitcoin price from January to December. It started out at over 50,000, ended up at 16,000. And you also see this very sharp drop there just at the end of June. It kind of fell off a cliff. And that led to the 11 million fundraise that had just been announced to actually fall through. So here we are in October now, October 2022, another announcement from Valkyrie. The investors pulled out. We couldn't foresee this earlier. Valkyrie didn't even foresee this, otherwise they wouldn't have made such a big deal of announcing it before. But fast, so the Valkyrie business definitely took a hit from it. I do know that they ended up laying off sales and marketing staff. However, some of the products that they have still on the books today, there's a Bitcoin mining ETF. There is a what they call opportunistic fund, where they actually attempted to take over the Grayscale Bitcoin trust that was the Bitcoin fund. There was some controversy going around over that fund. They still seem to be doing reasonably well. Actually, the mining ETF earlier this year was named as the fastest growing ETF in the US market overall. So it seems encouraging. In July 2000, basically just a couple of weeks ago, a month ago, July this year, we received an offer to participate in another financing round to buy another convertible note that would put Valkyrie at a $15 million valuation, which in turn would put our share now at a value of 167,000. Still more than the buyout offer that the CEO offered us a couple of months ago, but also quite a bit a step down from the 460K we thought we had at some point. Similar to Ionia, Valkyrie is not really supporting the Dash ecosystem anymore. I know there are some people in the community who are very eager for us to offload these shares. Again, we can't sell them on demand. Also, I believe it would not be in the best interest of the Dash network overall if we just participated in a fire sale under duress, like accepting this buyout offer that was clearly very much a lowball offer at the time. So I think with the information available to us at the time, it was the right decision to decline that. And even now, looking back at hindsight, it turned out to be the right decision because we wouldn't have left, tens of thousands of dollars on the table. Certainly, we are not really interested to keep Valkyrie on our books forever. We will be looking for an opportunity to offload the shares, but it has to be on favorable terms. Another company that is also dear to the heart of many Dashers is CrowdNode. This screenshot actually just from a couple of days ago, last week, this was finally fully registered. This is the screenshot from the Danish corporate registry. You can see there the Dash Investment Foundation now listed as holding a 12% share of CrowdNode. So we officially own part of it. If there's anyone who doesn't know what CrowdNode does, CrowdNode manages shared masternodes. So instead of saving up 1,000 Dash to buy your own masternode, you can invest with as little as 1 Dash and participate in the gains that you get from the masternodes. How much these 12% are worth to us is, in this case, particularly unclear. CrowdNode received 12 cycles from the Dash DAO, worth 2,160 Dash, or roughly 150K USD at a time. That funding came directly from the DAO. It did not come from us, from our books, so it didn't go through our books. But in a typical valuation sense, you would take, if 12%, if you get 12% of the company for 150K, well, then 100% of the company should be worth about $1.25 million. But then if you look at CrowdNode's business, that's illusionary. How their business works is like out in the open for everyone to see. You can just go to their website. You will see they manage 90 masternodes as of today. Their fee take is 15%. The Dash price is known to anyone. So we're looking at a revenue of roughly $2,350 per month. That's not even enough to pay one person's salary. And there are 4 of these guys working on CrowdNode on their free time, basically. So in a typical growth-based, business result-based valuation, this wouldn't really be worth much of anything. However, it's of very high value for the Dash community, and we're happy to support CrowdNode. We keep it on our books as a symbolic value of $1 for now. Now, another one. Last one I want to look into is 88i. Interesting also because it's a Brazilian company, so many of our other companies are American. CrowdNode is Danish. But you see, we're quite actually a global fund. 88i is an insurance technology and also an insurance company put together under a holding structure focusing on nano insurance. What does that mean? You can insure really small, tiny things. So the goal is to make that very simple and intuitive. For example, Uber drivers can insure loss of income on their daily drives. They have a pet insurance product. You can insure your cell phone against loss. Day by day, you can kind of turn it on and off as you need it. and they have a last mile delivery product. Now, you might be wondering, why in the world is the Dash Investment Foundation investing in an insurance company of all things? Well, 88i committed in building back-end business processes based on Dash platform, and that was one of the main reasons for us to do this investment. However, as everybody knows, based on that, and we're not talking about based on Dash Pay. So we're not talking about enabling their customers to pay their insurance premium on Dash. We're talking about back-end business processes on Dash platform. So, for example, storing when exactly was this cell phone insurance put in place, and when was it canceled again, and how does it overlap with a claim, or the last mile delivery run. If you're an Amazon delivery driver and you want to insure one specific delivery, that data has to be immutably saved somewhere. The company, they have to build their business. They can't wait for a Dash platform. There's still a commitment to utilize Dash platform in some way, although it's not quite sure, given the long delays we've had on our end in actually getting Dash platform released. It's not quite sure what that will eventually look like. But I did want to take a closer look at that Uber product that has actually been phenomenally successful. They launched a beta in I think it was April this year. They ran it for 4 months, signed up 4,000 policies for this beta, and then they finally rolled it out nationwide towards the end of July 2023. And that launch kind of hit it out of the park. Within the first month of the launch, they sold a 5-digit number of policies. I know the exact number of policies. I'm, again, not at liberty to disclose these eternal numbers, but let's just say they hit 58% of what they had set themselves to achieve by the end of the year after the first month. Also, claim payouts were below expectations, so it's a good thing. Few people actually claiming money back from their insurance. That doesn't mean it has to stay that way, but so the first month was, and also the beta was very encouraging. So much so that Uber is actually in discussions now with them about launching a second product. It does also come with a cash flow challenge, though, because of insurance regulations. There's another entity sitting in the middle, and each of those have payment targets. So basically, Uber has 30 days or sometimes more to pay Cover Genius. Cover Genius is a so-called managing general agent, MGA. They reconsolidate certain payouts and pay-ins, and then have another 30 plus days to until it finally hits the bank at 88i. That whole process can take up to 80 days. And so revenue they generated in August, they will see in that bank in November. Still, the business has developed very well. We're looking at EBITDA growth this year. EBITDA is a business term, stands for earnings before interest, tax, depreciation. Appreciation is kind of a drop-in for cash flow. After all costs have already been deducted. 88i expects to break even in November and grow significantly for the remainder of the year and into next year. So it's looking very encouraging. We had our first tranche of investment in 88i in April 2021. We invested a $250,000 time. At that time, it was the largest single investment we have done to date. There was a follow-up investment where we put in another 100,000. The company at the time was valued at 20 million. So together with the our previous stake, our share would have been worth over 400K at a time. Now, just this year, based on a liquidity crunch that I had just explained where that comes from, basically the Uber rollout had almost been too successful. So they had a bit of a liquidity shortfall. That didn't mean that they completely ran out of cash, but they have to maintain a minimum cash reserve that is required by the Brazilian regulators for insurance companies. They were falling below that threshold. So we gave them another 42K along some other investors. The valuation was 6.8 million. Now, there are two ways to look at that. On one hand, you could say, like, oh my God, like the valuation of that company dropped, like, our share also melted away, how horrible. But you could also say we got an awesome discount on this very small follow-up round, picking up a significant stake for relatively little money. And we feel justified in that because 88i is also looking at a Series A that they are currently already negotiating with investors. We also have the names of the investors that they're talking with. They target to close the round in March next year. Target valuation is also known to us. Again, I'm not at liberty to talk publicly about it, but it would put our diff share at roughly $640,000. So overall, if we look back at our investment at cost bookkeeping record, I'd like to put that side to side with the values that we have seen in the marketplace so far. The companies that I haven't talked about, Cordency, CoinRoute, they haven't had follow-up investment rounds, so we are not able to put a new number on that valuation. So we just keep them at the book value. It's possible that some of these companies may have taken a hit also from the crypto market. But overall, I think we estimate our portfolio at over $3 million in asset holdings as of today. And if you add those $3.2 million and you add to it our liquidity, our liquid assets, 80K that I showed earlier, it puts our total assets at about $3.3 million. And now to close it off, I'd like to contrast that to the funding we have received so far from the Dash DAO. I looked at MNO Watch, and over the years we have received a bit over 15,000 Dash. At the time of collection, that was worth just over 2 million. And you can see we've already been doing better than that, but the USD value today of those Dash, had we just kept the Dash, it dropped. So we would be sitting on 400K today compared to over 3 million. We're looking at a 8 times gain. And I think this is a pretty decent result. And with that, I don't know how much time we have left, but I'd like to open it up for any questions that you guys might have.
So I saw the crowding was there any profit intent?
Sure. Yeah, I'll repeat the question was CTX and CrowdNode were both listed with $1. So now remember, for bookkeeping purposes, we list our investments at cost value unless we have, or we keep it on our books, on our official accounting books at cost value. Now, both of those cases, the diff actually didn't have any costs. CrowdNode got funded directly from the DAO. We endorsed the funding request at a time, but we decided not to put our own money towards that investment because we could kind of see that just from a strictly business standpoint, we thought we could generate more value with the limited funds that we have available, investing those funds in startups that promise a bigger return on investment, financially speaking. But we were in favor of CrowdNode, and so we endorsed their funding request to the DAO, and the funding came directly from the Dash DAO. It never went through our books, but from CrowdNode side, to show their commitment to Dash, and also to kind of put people at ease. I had seen things like Living Room of Satoshi earlier, and say, "Oh, here comes another corporate entity, another commercial business trying to build a profitable company, with our money," just to put those concerns at ease. They promised 1% of equity to the diff for each funding round that would successfully conclude, and they went through 12 rounds. So that's how we ended up with 12%, but we never paid anything for it. So that's where the symbolic $1 comes from. Same for CTX. CTX is a company run by Ash Francis, used to be a supervisor at the diff. It's also a payment processing company and he offered a share to the diff basically at no cost. And so it's listed at a symbolic $1.
Question from the exploring, hold on.
Well, so why is the diff holding onto the Valkyrie shares? I thought I explained that during my presentation earlier. I don't know if I should repeat it all, but basically it comes down to us not being able to offload shares as we see fit. We have to wait for a financing event that allows us to sell. And also, we don't want to sell these shares at terms that are very unfavorable to us, because in turn, that wouldn't do a favor to the community. I understand that it is also our mission to promote companies that provide value to Dash. Valkyrie doesn't do that anymore. So that part of the reason of investing in Valkyrie is gone. However, I think it would still behoove us to get the maximum financial return out of it now once we are invested in it. And we have our money in it already. I think we should strive to make the best out of a bad situation and try to get the best price that we can get for it, which means not just trying to find somebody who will take these shares from us at really bad terms, just so we can get rid of them, just to make a point and out of spite. But we're still trying to create at least financial value for the Dash community from that. And when Valkyrie has a follow-up financing event, an exit opportunity presents itself, be that a merger, whatever it may be, we will certainly look into offloading those shares. On the slide, you show CrowdNode cash negative. What is necessary for CrowdNode to be cash positive? Is it totally dependent on the Dash market price? Well, short answer, yes, of course. If the Dash, again, all these numbers are public, right? Everybody can just whip out a calculator and run the numbers themselves. There's no secret. Their business depends tremendously on the Dash price. And at $27 today, they're bleeding. Yes, they are cash flow negative. There are two ways that could change. Either they dramatically increase the number of master nodes they run. I believe there's a limit to how many master nodes they could set up, or the Dash price increases. There are potentially alternative options, like they could look into maybe doing the same with the coins. But also, given that they're not able to work on this full time right now because they're not getting paid for it, they're doing it on their free time. I don't see having the development capacity at this point to develop a solution for other coins. So I don't want to speak for them. They're quite active in the community. You can feel free to put your questions directly to Andreas on the Dash Discord. They have their crowd mode Discord also. They are active on Telegram, and I'm sure they'll be happy to answer those questions.
We're kind of out of time. Spin off camera.
Yeah.
Well, then, thank you very much. It was a pleasure.